It's April 2025, and many companies are thinking about tariffs, the impact of tariffs and supply chain management. But before you make a change to your supply chain, you need to think about the cost of both labor and materials and whether you'll be worse off if you make a change to your supply chain. It might affect profitability. This chart was taken from the Washington Post. April 11th is the date because things are changing so much, you need to know the date. So it says before Wednesday, Trump's reciprocal tariffs. After Wednesday, the tariffs as they look after certain tariffs were suspended. So we can see that European Union 10%, let's look at the big numbers. Mexico 25, China still a huge number, 145%, Canada 25. So we have multiple countries, all with multiple percentages of tariffs, which makes things difficult. Which brings us to an article from CNBC that the tariff plan is throwing into disarray companies' efforts to diversify out of China. And what we find out here is that a lot of companies were diversifying out of China, specifically into Vietnam and Taiwan, because they saw things coming on Chinese tariffs going up. And so he talks about a company, an Illinois-based company here that moved from China to Vietnam, and now we have high tariffs on both of those countries. And this is causing huge frustration, not only for this company, but lots of companies that are trying to figure out where to put their supply chain. When you move and change your supply chain, you're going to have a different set of both material costs and labor costs. And that's what I want to talk about next. So let's talk about labor cost variances. So you move your supply chain from one country to another, or even from one region to another, and you're going to have variances. Variances are differences between budget and actual costs. There's two reasons why variances occur. When it comes to labor costs, you may pay more or less than you plan. We call that a price variance. Or you may use more or less than you plan. You call it efficiency variance. So if you're baking a pie, for example, if the ingredients are more expensive than you plan, that's a price variance. If you use less flour and other materials than you plan, that is an efficiency variance. So to make an easy example, let's assume that your budget is an Amazon driver making $20 an hour. They expect to deliver 50 packages in 5 hours. What actually happens is you have to pay the driver more, $21 as opposed to 20, but the driver delivers packages faster. This driver delivers 50 packages in 4.5 hours. So you actually have two sorts of variances. So the price variance is actual quantity times actual price, multiply those together to get 94.50 versus actual quantity times budgeted price. There's that $20. Multiply that together, you get 90. And what I have in red is it is an unfavorable variance because your actual costs calculate to be more than what you budgeted. So if you change your supply chain to another company, you may end up with an unfavorable variance. You could also have a favorable variance, however, though. A labor efficiency variance, which has to do with actual quantity times budgeted price, which are the same numbers you saw here. We compare that to a different figure, which is both budgeted quantity times budgeted price. We come up with 100. And in this case, it is it is a favorable variance in green, meaning that the actual costs were less than budgeted. Less than budgeted is favorable, more than budgeted is unfavorable. You add the two together to get your total labor variance. If I add the two together, it's a net favorable variance, meaning that if you change your supply chain and have these figures as your budgeted and actual labor costs, you are better off in the new situation than you were in the old situation. Now, bear in mind, this also applies to materials because you could, if I go back up here, pay more or less than planned for materials. If you're making baseball gloves, you may pay more or less for leather material. You may use more or less than planned in using the material to make baseball gloves. It's leather to make baseball gloves. Maybe if your staff works more efficiently, they use less leather per glove, they have less waste, and you would have a favorable variance in terms of material. If they wasted a lot of material, you could have an unfavorable variance in terms of material. So that's the differences that you need to consider when you're doing analysis, variance analysis on labor and material costs. With the tariff situation, everybody is debating the need to change their supply chain. But remember that you need to do some analysis on both labor costs and material costs to determine the impact on profitability of making a change to your supply chain.